Good evening. I am your host, and welcome to Kenya News Update today. We begin with a story that connects Wall Street to Tokyo, Silicon Valley to Nairobi, and shows just how interconnected our global financial system truly is. Tonight, we are diving deep into the market tremors that began with a single tech giant stumble and are now rippling across the world. The headline: Asia markets are set to open lower after a Wall Street pullback, all triggered by a surprising slump in the AI champion, Nvidia. This is not just a story about stock tickers, it is about the trillion-dollar question facing investors worldwide. Has the artificial intelligence investment boom reached its peak? We will unpack the numbers, analyze the fallout, and explore what this means for markets from Japan to Kenya over the next 12 minutes. Let us set the stage. For months, the narrative has been unshakable. Artificial intelligence is the future, and Nvidia, with its powerful chips, is the undisputed king supplying the picks and shovels for this digital gold rush. Their financial results have been nothing short of spectacular, fueling a market-wide rally. Just this week, Nvidia reported record annual revenue of $215.9 billion, a staggering figure that still beat analyst forecasts. Their CEO, Jensen Huang, declared that computing demand is growing exponentially. Yet, despite this blockbuster report, something peculiar happened. Nvidia's stock price did not soar, it slumped. And when the $3 trillion titan sneezes, the entire market catches a cold. The Dow Jones fell by 0.54%, the S&P 500 dipped 1.18%, and the tech-heavy Nasdaq slid 1.5%. This immediate negative reaction to positive news is what economists call a sell the news event, and it has sent shockwaves far beyond U.S. borders. Now, let us turn our eyes to Asia, where the trading day begins as America sleeps. The reaction was swift and clear. Japan's Nikkei 225 futures, traded in Osaka, pointed decisively to a lower open. This is particularly significant because just the day before, on Thursday, February 26th, the Nikkei 225 benchmark index itself did something extraordinary. It breached the 59,000-point level for the very first time in history, a record high that symbolized the immense optimism in Japanese markets. But that optimism is now being tested. Analysts are predicting opens down across the board. South Korea's Kospi is also looking at losses, while Australia's ASX 200 is expected to open flat, up a mere 0.03%. The message from the futures markets is unambiguous. The hangover from Wall Street's Nvidia-induced headache is being felt in real time across the Pacific. So we have to ask, why? Why would a company posting record-breaking results see its stock fall and drag down global markets? To understand this, we need to listen to the debate among investors and analysts. There are two primary schools of thought at play here. The first is the valuation argument. Proponents of this view, like veteran analyst Michael Hartnett from Bank of America, argue that the AI trade has become dangerously crowded. He points out that the Magnificent Seven tech stocks, which include Nvidia, now make up a historically large portion of the S&P 500. When so much money is concentrated in so few names, any stumble creates disproportionate volatility. The fear is that expectations for Nvidia had become so astronomically high, priced to absolute perfection, that even a stellar report could not meet the market's fever dreams. A slight miss on guidance, a hint of slowing growth in one segment, and the house of cards begins to wobble. On the other side of the debate are the true believers in the AI revolution. They see the Nvidia slump as a mere blip, a healthy correction in a long-term, multi-decade megatrend. Their argument hinges on the fundamental demand Jensen Huang described. Companies worldwide, from cloud giants like Amazon and Microsoft to automakers and pharmaceutical firms, are in a literal arms race to build AI infrastructure. They need Nvidia's chips, and there is no ready substitute. This group points to the concrete numbers, a 73% year-over-year sales jump in the last quarter. They argue that the sell-off is driven by short-term traders and profit takers, not by a change in the underlying economic reality. For them, this is a buying opportunity, not a reason to panic. Let us visualize the immediate impact of this debate on U.S. indices. The Dow Jones Industrial Average, representing 30 major blue-chip companies, closed down 0.54%. The broader S&P 500, a benchmark for the entire U.S. stock market, fell by 1.18%. And the technology-focused Nasdaq Composite took the biggest hit, dropping 1.5%. This gradient of loss tells a story. The more tech-heavy the index, the harder it fell, directly linking the pain to the tech and AI sector Nvidia leads. Now, how does this connect to us here in Kenya and across Africa? The link is through global capital flows and investor sentiment. First, consider foreign investors. A significant pullback in major markets like the US and Japan often leads to a phenomenon called flight to safety. International funds managing Kenyan assets, whether in the Nairobi Securities Exchange or in government bonds, might decide to pull some money out of emerging markets like ours to cover losses back home or to park it in safer, more liquid assets like US Treasuries. This can put downward pressure on the Kenyan shilling and cause sell-offs in top NSE stocks like Safaricom or Equity Bank, which are favorites of foreign portfolios. Second, there is the commodity angle. A slowdown in global tech investment sentiment can dampen demand forecasts for key industrial metals. While Kenya is not a major metals exporter, our regional neighbors are, and their economic health impacts ours. Furthermore, a stronger US dollar, which often rises during market turmoil, makes Kenya's dollar-denominated debt more expensive to service. With the National Treasury carefully managing fiscal policy under President William Ruto's administration, any external pressure on financing costs is a serious concern for our economic planners. Third, and perhaps most crucially, is the long-term investment narrative. Kenya is positioning itself as a tech and innovation hub in Africa. We have a thriving tech scene in Nairobi's Silicon Savannah, ambitions in semiconductor design, and growing data center investments. The global appetite for funding AI and tech startups is the lifeblood of this ecosystem. If Wall Street's love affair with AI cools significantly, venture capital funding could become more scarce, and valuations for African tech unicorns could face a harsh reassessment. The success stories we celebrate could find the next round of funding much harder to secure. Let us bring in a hypothetical local perspective. Imagine the CEO of a Nairobi-based fintech that uses AI for credit scoring. She is watching these market moves closely. On one hand, a Nvidia slump might mean the powerful GPU servers she needs for her models could become slightly cheaper or more available if global demand dips. On the other hand, if her company was planning a Series B funding round with international venture capitalists later this year, she might be worried. Those VCs just saw their own public stock portfolios take a hit. They may become more cautious, demanding more equity for less money, or delaying investment decisions altogether. Her growth trajectory is now subtly tied to the stock price of a company in Santa Clara, California. Looking ahead, what are the key signals investors in our region should watch? The first is the opening bell in Tokyo and Seoul. Will the predicted losses materialize, or will Asian buyers see value and step in? The scale of the sell-off in Asia will set the tone for European markets later today and eventually feed back into Wall Street tonight, creating a feedback loop. The second signal is the US Federal Reserve. In an environment where growth stocks like Nvidia are wobbling, the direction of interest rates becomes even more critical. The Fed's next meeting in March will be scrutinized for any hint that rate cuts might be delayed, which would further pressure high-valuation tech stocks. President Trump's administration has consistently advocated for lower rates to fuel economic growth, creating a fascinating dynamic between the White House and the independent Fed. Finally, we must watch Nvidia itself. The next major data point will be its next earnings report. Was this slump a one-time correction or the beginning of a longer trend? Analysts will dissect every word from Jensen Huang. Is the demand from Chinese customers, hampered by US export controls, holding up? Are competitors like AMD or in-house chips from Google and Amazon making meaningful inroads? The answers to these questions will determine whether this is a pause in the AI march or a potential stall. In conclusion, the story unfolding from a single stock's performance is a masterclass in 21st century globalization. A dip in Nvidia's share price in after-hours trading in New York directly influences the opening price of the Nikkei 225 in Tokyo, which affects the sentiment of traders in London, which ultimately influences the investment decisions made right here in Nairobi. It underscores a fundamental truth. In our interconnected world, there are no purely local markets anymore. The AI revolution promised to reshape industries, and it is certainly reshaping global finance in real time. For Kenyan investors, policymakers, and business leaders, the lesson is to watch these global cues not as distant noise, but as direct inputs into our own economic equation. The trillion-dollar question of AI's valuation remains unanswered, but its impact is already being felt in every corner of the interconnected financial world. This has been a deep dive into the markets. For more analysis and local impact stories, subscribe to Kenya News Update today.